Yo, what's up guys? Welcome back to the channel. In this video, we're actually going to be going over a couple dividend stocks that you should buy and then literally never sell them. So of course, I've carefully selected all of the stocks on this list where most of these have very safe and conservative dividend payout ratios. So if and when in the future there's a rainy day and their EPS maybe is negative year over year, these companies still have tons of room to raise the dividend. And since they're making so much money, they're also doing stock buybacks and they're holding on to a lot of cash, which right now, if your company has a lot of cash, all they're doing is put their money in the money market funds, in the T-bills, and they get a risk-free 5.5% yield, and the money is still liquid. So anyway, I can't wait to show you the first stock on this list, and it is actually ticker symbol CMCSA. So this company is a really big company with $154 billion market cap, and the dividend yield is literally 3% right now. But the valuation is what's super intriguing about this company. Look at the PE ratio. The PE forward ratio is a 9.27. So this company is literally dirt cheap. But check this out. This is what's super impressive about the company. They have grown their earnings per share or their net income per share 6.53% year over year. And check out the free cash flow per share. This is my more favorite metric to look at. It's up 15% year over year. So let's look at the EPS. It was nearly $1 in the most recent quarter, and their dividend from this literally cost 31 cents. They actually just rose the dividend by nearly 5% to $29 cents to 31 cents, and the yield is 3.16%. So let's say they doubled it to 62 cents. They could still afford that with their earnings per share and their free cash flow per share. So that's what I'm saying. This company can easily afford the dividend. So let's actually look at their net income, for example. They made $3.78 billion in the most recent quarter. Let's see how much their dividend costs from that. So this is a payout ratio based off their net income. So on top of the 3% dividend yield you get with Comcast, where they spend $1 billion a quarter, check out how much they're spending in stock buybacks every single quarter. They're spending more money on stock buybacks every single quarter than dividends. And remember, they have a 3% dividend yield. What is the stock buyback yield? I'll actually show you that exactly, but they spent $2.6 billion in stock buybacks just in the most recent quarter. So if you go to the total common shares outstanding, you actually now own 5.84% more of the company than you did 1 year ago. So yeah, they literally bought back 5.84% of the entire market cap. Remember, the market cap is $154 billion. So that's what I'm saying. The company not only has a 3% dividend yield, they have a 4% stock buyback non-cash dividend yield, if that makes sense to y'all. They also have $6.51 billion of cash right now, which is up 17% year over year, and the total debt is only $96 billion, which is down 4% year over year, and that debt is so easy for them to pay off. Remember, they can afford to do $2.6 billion of stock buybacks in 1 quarter, so they can, a year, let's see how much free cash flow they're making down here. They made $7.85 billion in free cash flow in the most recent quarter, so they could easily pay off the debt if that was a priority, and it's not a priority right now. All right, so the next stock on the list is actually United Rentals, and I really want to buy this stock right now. If I had some new money right now, I'd be buying United Rentals because look at the valuation. They're trading at a very fair 15 forward PE ratio. Now check out the dividend yield. It's only 1% right now, but look at the dividend growth of the company. They actually just started paying out a dividend because they make so much money. So remember, they have a 1% dividend yield. Let's see what the payout ratio is. So remember, $1.63 is how much their dividend costs per quarter. How much EPS are they making per share per quarter? Well, they made $8 in the most recent quarter. So just in the most recent quarter pays for the entire year of dividends. So they have so much room to easily afford to double and triple their dividend to a 3% yield plus. And check out the free cash flow per share. It gets even better. So their earnings per share, their net income per share was up 24% year over year. The free cash flow per share was up 13% year over year. And they make a lot more free cash flow than net income, which is pretty impressive. But look at this, $542 million of net income and $1 billion of free cash flow. So let's look at the free cash flow. Remember, they made $1 billion and their dividend from this cost $110 million. So they literally have a 10% payout ratio. And so what are they doing with the rest of the money? They're spending 3 times more amount on stock buybacks than dividends. So right now I'm in a position where I love companies that do stock buybacks and dividends. So you get that with United Rentals and Comcast. So these are 2 companies that are very financially stable, like very, very financially stable. Like you can't make this up. So even though the 1% yield doesn't seem attractive, this company makes up for it because of all the stock price appreciation. Like, let's actually zoom out and show you this. So I normally would not buy this company because it's at all-time highs, but the valuation makes sense. That's the thing. That's the thing people don't understand. The forward P ratio of 15 is very fair. All right, so the next stock you guys will really like if you want a very high yield that's also very sustainable. So this company is ticker symbol EPD, and they have to pay out this 7% dividend yield by law because they are an MLP. But check this out. They have a PE ratio of forward PE ratio of 10. So this is another company that's trading at a very fair PE ratio, and they have a very high dividend yield. But this company has a high dividend yield because they have to. So they also have a very nice history of growing their dividend. Like not too long ago, their dividend was 49 cents. Now it's 51.5 cents, which is pretty cool that they're committed to growing their dividend for shareholders. But check this out. Since they have to pay out 90% of their net income, it makes sense that their payout ratio seems pretty high from their EPS, but that's not concerning at all. So if we actually look at their free cash flow per share, they actually have a lot of room to raise the dividend. They made nearly $1 in the most recent quarter, and it was up 33% year over year. But even on the super bad quarter 1 year ago of 72 cents, that still easily affords the 51-cent dividend. And even if we go to EPS, they never made under what their dividend cost. This is a very consistent, slow and steady growing company. So let's actually now visualize the payout ratio. So they made $1.48 billion of net income in the most recent quarter. And how much does their dividend cost? $1.12 billion, which is very, very fair. And if we go to the diluted weighted average shares, you basically have not been diluted as a shareholder, only up 0.92%. And they do have a history of buying back their own stock. Check this out. I'm never seeing a quarter where they issue any stock. So this is every single year that they've basically bought back a little amount of stock. Well, let's see. That's basically $200 million in the most recent year and $200 million in the market cap of $61 billion. Well, let's say we'll take it. All right, guys. So the next stock on the list actually makes up 4% of my entire portfolio. It's kind of in the same industry as EPD, but this company actually makes so much money that they actually pay out special dividends a bunch of times. Like if you look right here, all of these little dividends, it almost looks like they pay monthly with how many special dividends they're doing. So this company actually has a rule where they will return 60% of all free cash flow that they make to the shareholder, either through special dividends or stock buybacks. So this is another company that does a ton of stock buybacks. But check this out. They have an organic 91-cent dividend. If we go to the history, you can see all of the special dividends that they do. But let's remember, their normal organic dividend just costs 91 cents. And without the special dividend, the yield on that is 2.99%. So check this out. The 91-cent dividend is easily covered by the $3.10 that they made in earnings per share and net income, and that's in the most recent quarter, which was down 10% year over year. We had a hard quarter to compare to because 1 year ago it was up 400% year over year. But check out the free cash flow per share. This is another really good metric I like to look at. It was $5 in the most recent quarter. So even though it's down 5%, it still easily covers the 91-cent dividend, where they could double their dividend right now to a 6% yield, and they could still easily afford the dividend with their net income and free cash flow. So that's why they're doing a ton of special dividends and stock buybacks right now. So their organic dividend cost $525 million. All this other quarters where it's over $1 billion is all the quarters where they do all these special dividends. If you look back here, that's where they were just doing special dividends every single quarter. But now they've switched up their strategy from doing special dividends to now doing stock buybacks. So in the most recent quarter, they literally bought back $760 million of shares, which is just over 1% of the entire company. So this company literally bought back 10%. And let's look at the market cap over here. It's $70 billion. And the company right now has total debt of $3.8 billion. So they have $3.8 billion in debt. And in cash, they have $5.3 billion. So they could pay off all their debt right now if they wanted to. But this is what's super impressive. They have $5.3 billion of cash after paying out the dividend and this huge stock buyback. So if they didn't do the stock buyback, they would have $780 million more dollars to their cash. And so that's why this company, in my opinion, is very financially stable. Their retained earnings are up 23% year over year. So this is a company, in my opinion, not financial advice. They could double their dividend right now if they wanted to. And if you hold this in a taxable account, they pay qualified dividends. EPD does not pay qualified dividends. So you'll actually get a 6% dividend yield if they double their dividend and it's qualified, which is the same as realty income, which is kind of crazy. So let me know your thoughts on this company. The PE ratio makes sense. The PE ratio is literally at 9.62 in the trailing 12 months. So that's all I got to say about this company. This is a financial analysis. This company is in the oil and gas industry, so you got to be careful if you don't want to be exposed to the energy and commodities sector. But yeah. All right, guys. So the last dividend stock on the list is actually Johnson Johnson, and they're also trading at a very fair valuation at a PE trailing 12 months of 9.74. I feel like every stock on this list, they're all trading at very fair PE ratios, and the dividend yield is 3.36%. So that is a very safe, very good dividend yield, and they have tons of billion-dollar brands, Johnson & Johnson, but their EPS looks a little weird because they have acquisitions, and their numbers got hit from the lawsuits and stuff. So let's look at the historic norm. As you can see, I think they're above the 2020 levels. So right now in the most recent quarter, this is my point. They made $3.26 billion of net income. And let's actually go to the free cash flow. And free cash flow, they made $3.66 billion, which seems in line with normal. But remember this number, $3.66 billion, and their dividend from this cost $2.87 billion. So that actually is a little higher payout ratio than all the other stocks in this video. But they also have a very juicy yield, and their income is very, very reliable. But you actually now own, wow, I didn't know this, 6.73% more of the company than you did 1 year ago. So yeah, they bought back $1.28 billion of their own shares. Looks like they had that one quarter where they issued stock, but that's like the first time they ever issued shares. This company has a huge history of buying back their own stock. So remember, the quarter before this, they made $7.86 billion in free cash flow. So when you average out the 4 quarters, the dividend payout ratio is looking a little better. On average, they probably make around $4 billion a quarter. But this is some good news. Their total debt is actually down 36% year over year. So 1 year ago, they had $52 billion of debt. Now they only have $33 billion of debt. In cash on hand, they have $3.82 billion of cash. So yeah, that's Johnson & Johnson. If you want to help out the channel, don't forget to leave a like on the video. And if you leave a comment, I will respond to every single comment. But if you have any other dividend stocks you'd recommend, let me know in the comments.